not just in isolation, gold, buy, hold, inflation, deflation, audit the Fed, conspiracy. No, we're going to talk about gold, how it fits within the monetary, the shadow system. Where does it fit in the Eurodollar framework? And what does it have in common with Treasury bill yields, the Federal Reserve's reverse repo program holdings, and early morning repo collateral scrambles? But first, ladies and gentlemen, if this show was sponsored, a potential sponsor might be YouTube, where you could find all manner of cat videos. But also, on August 3rd, you will be able to watch and commemorate the 14th anniversary of the Oracle of CNBC losing his mud on Squawk Box. Yes, Jim Cramer, August 3rd, 2007, came on and was absolutely apoplectic, talking about how the Federal Reserve is out to lunch and people are losing their jobs and firms are going to go out of business, and it's nuts. And the Federal Reserve has no idea what it's out like there, and screaming, and it's wonderful. We haven't seen anything like it since Bill O'Reilly lost his mind on Inside Edition. You remember that? And he said he was going to do it live. Well, ladies and gentlemen, it turned out that a few days later, the FOMC met and they laughed at Cramer on August 7th, 2007. Jeff Snider, head of global research for Alhambra Partners. What other memorable comment was made on August 7th, 2007?
I think there were quite a few, actually, although I'm not sure how many people are aware of them or how they probably don't realize how memorable they were. But to me, the most famous from August 7th, 2007, and again, this is one of those emergency FOMC conference calls where they got together and said, well, there's a lot of chatter out there. Things are going on. What are you guys hearing? Because we don't see anything wrong here. And at the time, a guy by the name of Bill Dudley happened to be the open market desk manager, which is probably the Fed's most important position inside of the Federal Reserve. I mean, the chairman gets all the attention, and really that's kind of the point. Everybody looks at the chairman and gets Ben Bernanke and his persona. But as far as the function of monetary policy, the open market desk, the system open market desk manager, is kind of the go-to person when it comes to the nuts and bolts of these things. And that was Bill Dudley back in August 2007. And he said, I've talked to people on the street. Ha! There's nothing going on. We don't see anything imminent anywhere. I'm talking commercial paper, countrywide, mortgages, all of this stuff. Nothing is imminent.
And how many days later, after that meeting, did the crisis begin?
Exactly 2 days. 2 days later, not only was the crisis imminent, it was there, wham. And as we talked, I mean, Northern Rock CEO put it best: the world just froze, or everything just stopped on August 9th. And here are these geniuses, these wise monetary stewards on August 7th saying, there's nothing imminent. And the funny thing about it was, what made this quote memorable, even more memorable in my mind than Ben Bernanke's subprime contained the fiasco, was that Bill Dudley identified several things that he said were not imminent. There was no trouble imminent. And among them was commercial paper. So nothing imminent in commercial paper, when 2 days later, the commercial paper market as we know it ceased to exist. So that's pretty much how good these people are in the internals of monetary policy. I mean, this one goes in the Hall of Fame of worst possible takes.
What they should have been doing is looking into the shadows, into the monetary system. Now, you can't look into it directly. You can't measure it directly because it's in the shadows. We have to measure the monetary system's impact on other things that are visible, and then interpret what that might mean. And over the last several weeks, we've been talking about US Treasury bill yields, the level of the Federal Reserve's reverse repo program, the holdings, and then also collateral scrambles very early in the morning in the repo market. And in your article called Golden Collateral Checking, that was posted on the 26th of July at Alhambra Partners, you bring a fourth measure into the discussion that we want to keep an eye on. And I think people would be very surprised that it's the ancient metal when we're talking about the modern monetary system. Tell us a little bit why gold
Yeah, it's not only just the ancient, the what used to be money. Actual money was, physical metal. Nowadays, we use the term money loosely on pretty much anything, which, I guess, defines the era that we've gone through, the Eurodollar era, where we've blurred the lines and definitions of money itself. But I think people are surprised, number one, that gold can kind of get caught up in this mess. Number two, in the ways in which it does get caught up in this mess, right? Because when we see these telltale signs of scramble for collateral shortage, whatever you want to call it, it ends up being negative for gold. Gold gets sold, it gets pounded, it gets slammed. Go back to last March. You and I talked about this a lot. Since you're in the precious metal business, you know this very well. On these same mornings where we see these liquidations happen, before the liquidations happen, during this repo window, as I called it, the early morning session, really up until about 9:30, 10 o'clock in the morning, most of the activity gets done up until the U.S. Open, and then there's a little bit scramble up until around, say, 9:30, 10 o'clock. But you would see T-bill rates just sink. They would just drop. And it was clear that there was so much enormous demand over and above investment considerations for Treasury bills. And you could match intraday in these overnight sessions T-bill rates with gold prices. And they would go tick for tick with each other. And even if you didn't have any idea what was really going on here, you would say, this is a correlation we can't just ignore. It's there, and it's there repeatedly. So something is going on that links these gold slams, these early morning gold slams, with what's going on in Treasury bills. And then, of course, when we get to the regular trading session, everything gets liquidated, including stocks and everything else that had been beforehand pretty much impermeable to any kind of negative factors. So we got a progression, a series of events that are all correlated together, that all look at the entire system as it's breaking down and telling you, as you pointed out, we're using what's going on in these visible indications to piece together what must actually be happening in the shadows. And gold was very much a part of that.
And gold slams, the way you look at it, is those early morning sales. Now, Jeff, that's of course perfectly correct, but you know what I did? I did a look myself, and my gold slam definition is a little bit looser, a little bit more liberal than yours.
Well, hey, as we said last week, there's terms of art here. We don't have we don't have precision. We don't have equations. We're not fooling ourselves like economists putting up an econometric regressions and telling you that we have a precision to the seventh decimal point. There's a lot of art here. There's a lot of analysis and opinion.
And you know what? Maybe I even said it wrong, that I have a looser definition. Maybe this is kind of a different vintage or a different fractal, a time. There's the short ones that you're talking about, but I'd like to draw attention of the dear audience to a little bit longer slams that do also correspond to another kind of collateral sale. And so the graph that I've pulled up right now is the gold price. That's the gold line. And then the little bars, the area graph at the bottom, that represents US Treasuries, but custody holdings by the Federal Reserve for foreign official and international accounts. Jeff, you'll do a much better job explaining that. Can you just tell the audience what these things are and why they're important? US Treasuries in custody.
That is the reserve managers around the world who, as the Eurodollar system developed and threw off all of these dollar resources into various countries, a lot of those dollar liabilities or dollar assets became into the hands of foreign official institutions, whether they be central banks or foreign treasuries or something like that. And as an accommodation to help out foreign governments around the world, the Federal Reserve Bank of New York custodies those U.S. Treasury assets on their behalf. So it the Federal Reserve Bank of New York actually acts as custodian for these Treasury accounts. And there's not just Treasury, there's other assets too, but we're specifically dealing with Treasuries here. And if you graphed the absolute value of those, what you see is they rise rapidly during the Eurodollar mania era up until the first financial crisis. And then we get into the post-2008 period, it gets a little strange, where we see the level of Treasuries in custody at Federal Reserve Bank of New York on behalf of foreign officials tends to decline when we see these other kinds of indications of a dollar shortage. And so it goes together with the tick data and this is separate from tick. It goes together in the tick data where it says treasuries tend to disappear from foreign hands when there's a dollar shortage. And that kind of makes sense. Either they're being used in some other compassion, in some other fashion, being lent out to other local banks that are starved for dollars, or just sold outright, liquidated to raise cash to pay off Eurodollar liabilities. So here we have, and I love how you've gone all the way back to 2011, Emil, to show that this is not just last March. This is something that we can look at dependably, where gold is definitely part of this mix, where we can say, look here, we have a couple different indications from very different sources. One, real-time data and market prices. Another one, a custody account of the Federal Reserve Bank of New York. We put those two things together, and there's a collateral dollar shortage indicated in both of these things. And it's very consistent going back more than a decade.
That's right, exactly. So you would notice these things should be rising if the monetary system is expanding. Custody holdings. We see sales rarely, and consistent sales or sales in bulk, in volume, that's during these dollar shortages. And look at what we see with the gold price, which I've circled here. Significant falls. That's just 2011. Here's from 2014, Jeff. Again, sudden sales in custody, and then drops in the gold, material drops in the gold price over several weeks. That's not only it in 2014, we saw it in 2015 as well. And as you were just mentioning earlier, 2020 as well.
Yeah, we have, we can go back to all those, back to 2011, for example. The graph that you showed there, where did those treasuries start to disappear from the custody account? In August of 2011, what happened in August of 2011? Well, August 9th, 2011, there was another one of those emergency conference calls on the Federal Reserve where they said, we can't believe what's happening here. We've got 1.6 trillion in bank reserves, and yet we're talking about bailing out the repo market because illiquidity is TAF auctions and overseas. We need to go back into crisis mode, even though we've quote unquote printed 1.6 trillion in bank reserves. And that correlates. So we have a very consistent correlated story that links gold, the custodies and treasuries, to TIC, to T-bill yields, and even FOMC discussions talking about illiquidity deep inside these markets. And I want to go back to, Emil, something you said earlier.
Okay.
The visible spectrum of dollar shortages. It's not something the Fed didn't know about. Going back to 2007 even. In those discussions in 2007, Bill Dudley would say, there's weird stuff going on in the Eurodollar futures market. It's inverted. They would notice this stuff and then say, nah, no big deal. There's just a lack of somebody on the other side willing to take the trade and move the curve back to where it is. Not realizing what they were actually saying. The reason nobody was on the other side taking that trade was because they agreed with it, right? If you actually think there's not really much money in taking the other side of an inverted curve, then you agree with what the inverted curve is, that there's a probability of something bad, and therefore you not want to be long into a big crisis. So what happened was they did what we did. They're looking at these markets and saying, we're seeing these things move, but then sort of getting into this mode of denial where that can't possibly be true. We're the Fed. If we want to do what we want to do, we're going to do it. Nobody, don't fight us. And here we had almost a year period where the markets were saying, sure, you guys are the Fed, but we don't believe you're going to get this right. And that repeated in 2011 and again and again and again.
I think part of the reason for this latter point, Jeff, is because the Fed is so staffed with academics, which are perfectly fine people. Sounds like a wonderful life to be an academic. But I think you need more people from Wall Street who have had their rear sector handed to them by the market, so that you have some humility knowing this market is telling me something and it's important for me to pay attention to it. Whereas if you're an academic, you're highly credentialed, you're acclaimed, you're in the citadel of monetary power. Why should you listen to markets? Who's right? You? Yeah, not the markets. So I think that's a big problem, is this, well, like, I guess it's the ivory tower. The ivory tower.
Take that a step further, Emil, and it's even more correct, if for lack of a better term, because the academics focus on something else entirely. academic economists, and you're right, that's the people at the Federal Reserve or any central bank, they're academic economists. And what they focus on is mathematics. And not the mathematics of money, but the mathematics of these DSGE econometric models describing, okay, what's the relationship between inflation and unemployment? Or what is the multiplier factor for a fiscal stimulus package? There's no real place in those models for actual money. They just kind of assume, and they have assumed for a long time, they don't need to model money because the Federal Reserve gets what the Federal Reserve wants. And so why waste your time and brain power trying to come up with a model for a monetary system that you're convinced simply obeys monetary policy inputs? And so the academic economists start from a premise, the worst possible premise, which is they don't need to pay attention at all to any of these things. So when Bill Dudley's talking about inverted curves and Eurodollar futures, they're like, so what? That's not even in my model. My model is the world. It's the universe. So yeah, so that point you just made is, yes, that's the biggest problem here, is because the people, and the irony is, the people who are running the supposedly monetary center of the universe don't care about money at all. It's not even in their models, and it's kind of one of the weird ways that you can explain how things got to be the way they are, in a sort of very granular way. When you look at Bill Dudley talking about these things, and then all the people around the table going, no big deal. And then 2 days later, everything breaks down and they're all shocked and can't believe it. It actually does make sense. It's not just some kind of Hollywood story, really bad Hollywood script that got thrown out for being so unbelievably implausible. It actually happened that way.
Ladies and gentlemen, if you want to know more about the Federal Reserve, which I'd love to keep talking about, I've got several points I want to raise, but we're here to talk about gold. Then go to episode 92, where we spent 95 minutes reviewing the last 14 years of Fed actions through the lens of a recent Frontline documentary. All right, Jeff, I'm going to pull up your graphs now, where you've got gold and you've got US Treasury nominal and real yields, and just tell us what you're seeing and, I guess, why you wrote this article.
Well, normally there's a really good inverse correlation between gold and the Treasury market. And then we're going back a couple of years to 2018. It's almost perfect, and you can see it visually. I mean, it's a straight. It almost makes a perfect X here. And even in, I love how you brought in self-similarity and invariance to scale. It's not just a perfect X in the big time scale. There's also smaller perfect inverse correlations over shorter time periods. And that makes intuitive sense too, even though it doesn't necessarily from the mainstream perspective, which holds that gold is nothing more than an inflation hedge. And that's not really true. It's actually a very poor inflation hedge. You go back to the 80s, 90s, and 2000s, gold performed poorly against the CPI. What gold is a hedge against big errors. And the runaway inflation of the 1970s actually qualifies as one of the biggest errors in money and economics. So that's why gold performed well during the 1970s, once it was allowed to float in price, even though there was a two-tier pricing back to the 60s, so it sort of had broken away from the early state of the great inflation. So it's a big error hedge. But a big error doesn't necessarily mean runaway inflation. It could also mean deflation and fragmentation and monetary uncertainty, as we've seen since 2018. Because the big risks going back to especially October, November, December 2018 have absolutely not been runaway inflation, even though that's what they've all said in the mainstream media. Instead, we've seen inflation go down, the economy slump globally, and yet gold prices were rising, often precipitously, as bond yields were falling. So you have deflationary signal in bonds. What's going on in gold? Well, the same thing. And it makes sense because, gold's primary argument against holding gold is it doesn't pay any interest. So the opportunity cost to holding gold is essentially risk-free interest rates. So if you think risk-free interest rates are going lower and going to stay lower, the opportunity cost of holding gold goes way, way down. Therefore, that lends some more value and bid to the gold price. So that's why you can see this inverse correlation between Treasury yields and gold prices. Deflationary error signals.
And so you raise a few dates in your report. You raise, let's see, what dates are they? June 30th, July 1st, and July 15th. And why did you bring those dates to our attention with respect
Well,
to
if you
gold.
just on the chart that the part that I had circled, which was recently, it's kind of a it's our correlation broke there because as you can see on the right part of the chart, since middle of March, Treasury yields have fallen as well as real yields have fallen, but maybe not as consistently. So there's an argument there. But anyway, nominal Treasury yields have fallen since March, and gold was moving up as you would expect given lower yields. Then around the end of May, suddenly gold began to fall, even though Treasury nominal yields were falling too. So we broke our correlation there for about a 5-week period in a pretty severe way. Not the first time, but it's one of those things that you go, okay, what's going on in gold here? And it's the decline in gold prices ended on June 30th. And you saw it go back up in early July, up until July 15th. And now gold prices are kind of sideways to lower since July 15th. And these dates show up in the Treasury bill market. So we're kind of wondering here, are we seeing, like you had shown before historically, are we seeing a larger scale gold price decline that is indicative of collateral pressures? Because we saw those in T-bills during the same period. Late May and June, quite a bit of these instances of scramble for collateral, indications of shortage, rising levels in the reverse repo rate, which is an indirect indication of collateral scarcity. And all of a sudden now we have golds falling against falling Treasury bills, or Treasury yields, I'm sorry. One above it.
Oh, you want to see that one too? Okay, no problem.
The bill one. There it is. So you can see, May up until July 1st, Treasury bills are giving you that signal. There's excess demand for collateral, which is consistent with lower gold prices. And then that middle part of July, or the first part of July till around here, it says July 21st. All their secondary pricing models say July 15th, which is exactly when you saw the recent high in gold. So that it kind of correlates too. So you have to wonder, are we seeing these collateral pressures play out in the breakdown and the correlation of gold over the last, couple of months or so?
And the reverse repo program held by the Fed, which we've talked about on previous episodes, we believe it's several signals, one of which is there's a collateral squeeze shortage that is not being satisfied by the private market, so they're going to the Fed. And as you draw out in your graph here in this article, you note, hey, it started to rise again. We hit a peak, settled down, it's rising again.
Which again matches both T-bill rates and their behavior, as well as what happened short run in gold, right? Because we had that May to the end of June, we have rising RRP levels, the same time falling gold. And then the first couple weeks in June, all of those things kind of backed off. Gold rose, T-bill rates started to behave better, and even lower balances in the RRP. But in the second half of July, gold isn't exactly, it's been lower in some days. It's been up over the last couple, so it's kind of sideways. So nothing real definitive there, but it's not higher like it should be as US Treasury nominal yields are falling and real yields have been sinking. So you would think that gold sideways in a way is already sort of a red flag, because gold prices really should be rising much more rapidly given what's going on in the behavior of yields. So we're wondering, are we seeing a consistent signal here where RRP, Treasury bills starting to misbehave again, lower nominal long-term yields, and gold prices that are at least not rising like they might otherwise?
Jeff, I'm going to ask you to summarize this article if you have any further thoughts. But before I do, I want to go back to the custody holdings of US Treasuries by the Fed of Treasuries for, foreign institutions, and bring us up to date. And I think you'll be very interested by this graph. Here, I'm going to pull it up right now. So this is from the Fred site, and it goes all the way back to 2017. And let's say that was at the end of 2016 was when we had our last Eurodollar crisis, number 3, the Asian one, kind of stop. And what did we see? We saw custody holdings start to rise, as we would expect in a reflationary, expansionary monetary order. It peaked in early 2018. Again,
alarm
perfect.
bells. Yeah,
perfect.
Fits a lot, everything we need to talk about. Yeah.
Look at that, and then we see the landmine even in this memorandum item in a balance sheet of the Fed, we can see the monetary system. And then because in October, we started to see a serious decline, a recovery to the beginning of the year in 2019. And then from early 2019 all the way through the end of the year, we see a decrease, warning, warning, warning. And come the corona, big drop. Then a recovery during the reflation. Jeff, looking at the right side, what do we see? We saw a peak and now a steady decline.
Yeah, and where was that peak, Emil?
You will
Put your cursor
not
right on that.
be surprised.
March 18th.
Coincidence, Jeff Snider?
No, we don't believe in coincidence. Well, we do if it's, one thing correlates with another occasionally. That's a coincidence. But when you have, and to summarize what we're talking about here,
Thank you.
This is a memo item in the Fed's data. It's not something most people even as aware exists. But what we're doing here is, as you've laid out beautifully at the beginning here, we're trying to look at what goes on in the system we cannot directly observe. And so we have to piece together all of these behavioral changes. Does this change? Does this correspond with this? Does this correspond with that? And when you start fitting together very different pieces of data with real-time market prices, and it's one after another, after another, after another, that cannot be random coincidence. What we do here, because this is all publicly available information. We're not making this information up. You can all look at this. You can go to and look at everything we're talking about. All we're doing is trying to give people a sense of how to interpret these correlations that cannot be random. What is it that we think is going on that explains all these things? And what you'll find is it's nothing like what they say in the media or the textbooks or what comes out of Jay Powell's mouth, except for the occasional accidental truths that he spilled like he did to Congress when he said, not a lot of T-bills. So by and large, what we're doing is putting together the pieces, and even finding different pieces that fit into what is a consistent, coherent picture of what we believe is monetary reality, which then becomes financial reality, and eventually economic reality, which does impact everyone's daily life, whether they know it or not.
In part 2 of this episode, we're going to talk about the Asian financial crisis and foreigners selling US Treasuries. What does that have to do with our current economic recovery? You're going to want to know. Treasury bill yields, the reverse repo program holdings, early morning repo market collateral scrambles, and now gold. What do all these things have in common? They're warning something is happening, at least in those first 3. And the question is it happening in the 4th one as well? Gold, we're going to talk about it. Gold, gold, gold. Terrible. I can't do it. I'm not going to do that one over again.
I thought that was good.
Yeah, I don't know.
Take 2.
Take 2. Ladies and gentlemen, we're going to talk about gold. Gold.